Hey there, everyone. Happy Tuesday, December 9th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a actually rapidly flooding Redmond, Washington. We're on the outskirts of Redmond. We're actually in the next town over, and we live in a valley, and there are a limited number of roads that cut through this low valley around a river, major river coming off the Columbia River, and record amounts of water coming through. It rains in Seattle, but it's been raining an excessive amount recently. So they often call this area an island on the rare occurrences when the aggressive rain flow swells the rivers, the valley floods over, and our limited number of roads do not remain out of the water. And so we'll see. Thankfully, we've got power. We got plenty of food. We're safe. That's good. We're happy here up at in higher ground in the valley here, but should be an interesting challenge here for the next couple of weeks. So please be careful, those of you in the Seattle area. It is these are crazy times here. Having said that, hope you guys are all doing well wherever you're tuning in from. I appreciate you joining me here on the show. Our general approach to this show, we're going to talk about market conditions today. We'll just recap on what happened with the major averages and major asset classes. As you will find, the S&P essentially grabbed defeat from the jaws of victory. First half of the day, pretty decent. S&P making, its highest point right around the noon hour Eastern time, but for the whole afternoon, sort of rolled over. So the S&P finished slightly negative, and the NASDAQ slightly positive. Volatility increasing a bit, but still in our low volatility range. Breadth conditions took a big step back today. You're going to see the McClellan Oscillator close to turning negative, less than 50% of stocks above their 50-day moving average. Those are the kind of short-term rotations we're noting. So while the S&P and the NASDAQ remain very, very close to previous all-time highs, there's nothing bad about that, right? To be clear, long-term trends, medium-term trends still in very good shape. It's in the short term where we can begin to start to see signs of distribution. There's certainly been a change of character from the end of Q3 to the beginning of Q4. We're seeing less and less upside follow through, and we're seeing a lot more stocks going down than going up on days like today. Does that mean we're in a major corrective phase? Not yet. Does that mean that's a possibility? 100% yes. We'll look at the heat map. We'll talk about some individual stocks and groups on the move. We'll get to some charts. As always, if anything I'm about to share with you or show you draws some question out of your brain, please take a moment and put a comment on our YouTube channel and let me know. We'd love to feature one of your questions in our next all mailbag episode, which will be Friday of this week. Let's get to the market recap here. S&P 500 basically flat for the day. It closed slightly lower, just above 68.40. Earlier in the day, it teased 68.65, which looked like a nice follow through from the stronger close on Monday. But the afternoon was all negative. We ended up finishing in the red. The NASDAQ was slightly higher, and the mid-cap and small-cap indexes kind of mixed. Look at how the mid-caps just kind of fell off a cliff going into the close. Small caps, sold off through the course of the afternoon, as did everything else. But the rally out of the open was much more significant. So small caps here using the S&P 600, the best performing out of the major U.S. indexes. The VIX pushing almost to 17. It actually opened just above 17, pulled back a bit, but then back toward the close getting higher. So we're getting closer and closer to that threshold of 20, which for me is kind of that basic back of the envelope separation between a low volatility environment where we should expect smaller daily movements and less volatility, less uncertainty, versus a high volatility environment, which implies bigger swings, bigger movements, bigger potential downside for sure. All right, looking at some other asset classes we highlighted on yesterday's episode, breakdown in the TLTA confirmed head and shoulders top. It basically treaded water today, but interest rates continue to drift higher, particularly the mid to longer points on the curve. The 10-year yield up slightly, just below 4.2%. The long bond yield was actually down just a click, still just about 4.8%. And the 5-year yield's around 3.8%. This is going into today and tomorrow's Fed meeting. We're now in the last Fed meeting of 2025. Market pricing in a 25 basis point cut. A lot of expectations and uncertainty, and certainly a lack of clarity in terms of what the Fed may do. Part of that is the lack of economic data. We just haven't had nearly the flow of economic data that we normally have had. So for the Fed being, quote unquote, very data dependent in terms of, interest rate policy, not a lot of data to depend on right about now. So we'll see what sort of language we get. We'll see if there's a more dovish or hawkish tone to Powell's press conference and the Q&A session after. General playbook for a Fed meeting: expect low volatility, lighter volume before the announcement. That's kind of where we're at here. Expect quite a bit of volatility during the meeting and going into the close. The real measure will be Thursday's session, which is where everyone's had a chance to sleep on what they learned, and some projections, or a little more, informed anticipation of where the Fed policy may go. Starts to put the market on its next on the next path. Dollar just slightly higher from yesterday. Bit of movement here in the commodity space. You're going to see gold and especially silver had remarkably strong days. The GLD was up about 0.5%. Big movement in gold. The SLV up almost 5% today. We're going to look at both of those charts. You'll see how gold is in sort of a coil pattern. Silver kind of looks like the chart of gold, but after a really meaningful breakout. And you also see that comparing gold stocks to silver stocks. And I have an example of each that I'm going to show you how silver has really been leading gold, and that ends up being a pretty good sign for commodities. I'm drawn to my conversations over the years with Mish Schneider, who's at a firm called Market Gauge, and Mish is a former commodities trader. She traded agriculture, and we often talk about commodities in a little more detail. She would always say, look at silver versus gold, because that's sort of your risk on versus risk off. And so silver performing much better, definitely reminding me of that. Energy a little bit weaker, particularly natural gas prices, which continue to deteriorate today. Nice upswing in cryptocurrencies. Bitcoin is currently trading just below 93,000, although it did get above 94,000 earlier today in the US. Ether price is even better. Ethereum is around 3,300. That's up about 5.8%. You can see all 10 of the top coins tracked on the stock charts platform in the green. We've talked about 90,000 being a big round number, kind of an important psychological level. And for now, we appear to be pushing above that point, which is a very good sign. Sector-wise, honestly, about as close to a 50-50 kind of coin flip as you can imagine. 5 of the 11 sectors technically higher, 6 technically lower, although consumer discretionary was basically flat, almost exactly 1 penny difference from Monday's session. So almost exactly a split. On the upside, your top performers: energy, technology, consumer staples. None of these up a ton. The XLE was up about 0.2%. Technology and consumer staples both up about 0.25%. On the downside, healthcare down 1%, industrials and real estate rounding off your bottom 3. Here's the breadth. It actually wasn't as bad as I had thought, and it depends on where you look, right? On the New York Stock Exchange, 53% up, 44% down. On the S&P 500, almost flipped, 43% up, 57% down. The breadth in the small cap space was the best. 2 stocks up for every 1 down in the S&P 600. But for the rest of them, kind of mixed, right? The S&P decliners outnumbering advancers. The New York Stock Exchange advancers much stronger. Note that the top performer in the S&P 500 today was Newmont Mining, the only gold miner in the S&P 500. All right, looking at the Magnificent Seven and Friends, the mega cap growth trade. Broadcom continuing to impress and continue to I would say embarrass its fellow members of this elite club for having the strongest chart. I mean, Broadcom looks great. It really does from a technical perspective, up another 1.3%. That's, arguably one of the stronger charts I could highlight for you right now. Tesla also having a nice recovery, up 1.3%. Alpha pushing higher. Alphabet, that is, up over 1% as well. On the downside, Meta continuing to pull back after attempting to get above moving average resistance, down another 1.5% today. Nvidia and Apple both down about 0.33% from Monday's close. All right, we're going to go to the heat map here. As a reminder, please drop questions in the comments section on our YouTube channel. We would love to hear from you. We're planning some really cool events here between now and year end, trying to get all of that organized here this week. But we are planning a website most likely next week. As soon as I have that scheduled and ready for you, I'll definitely make an announcement here. Would love for you to sign up and join me there. As soon as we can get all that ready, hopefully tomorrow I'll share with you the details. So that's coming up. Market Misbehavior podcast. We got a couple great interviews coming up this week. I was set to sit down with Jeff Hirsch of the Stock Traders Almanac today. We had to push that back to tomorrow, but I'll be interviewing Jeff for the podcast, and then Julius DeKempener of RRG Research. Jeff and I certainly will be talking about seasonality. We'll talk about a Santa Claus rally, talk about seasonal playbooks for 2026. With Julius DeKempener, will be about sector and asset rotation. We'll drop some RRGs on you, talk about leadership versus laggardship. Some of the perceived and narrow leadership we've observed here in recent months. So a lot of great conversations. Latest episode that is available for you is with Steve Sosnick. He's the chief strategist at Interactive Brokers. Talked a lot about the AI trade, technology versus everything else, changes in market structure over the last couple decades, and just the nuances of how the markets are functioning, what that means for investors. A lot of really important takeaways from that conversation. So please make sure you check out our Market Misbehavior podcast. That's on our YouTube channel and all your favorite podcasting platforms. Market Misbehavior with Dave Keller, it is called. All right, here's the heat map. So what stands out to you? I mean, talk about a day where technology was not nearly as dominant as it has been. Kind of the average day recently has felt like bright green in the upper left and then kind of mixed results elsewhere. Today, it's sort of a little better spread out. And I would say the financial sector looking a lot better than normal, with charts like Blackstone starting to bounce higher after having some pretty weak movements in October into mid-November. Sticking with the financial sector, JP Morgan down pretty significantly today. All of a sudden, taking a head and shoulders top kind of vibe. It's almost a confirmed head and shoulders pattern, but not quite. I did grab that chart and drew some lines on there to talk through with you what it means to have a potential head and shoulders pattern, how you can kind of use that, what levels you want to look for. So we'll get to that a little later in the show today. Within technology here, obviously the biggest names not doing particularly well, except for Broadcom. Broadcom continuing to outperform, continuing to make new all-time highs again today. Pretty impressive. AppLovin is another one of those, just breaking out, up another 5% today, powering above $700 a share. That's where it topped out in September. So we'll see if we're able to gain a foothold above that level. But semiconductors generally are continue to be the strength here in the technology sector. Elsewhere, very mixed, and you're going to note some general distribution signs in sectors like industrials and charts like Boeing, making a clear pattern of lower highs and lower lows here in the fourth quarter. Same for Uber, kind of pulling back after making a higher low. I mean, the average stock in the industrial sector starting to look a lot less awesome than it was not too long ago. And so, charts like GE Aerospace, when if I'm asked like what's changed, like the chart of GE is a perfect example. I mean, through the end of October, this is arguably one of the better charts you're ever going to see. And I would say there's a couple phases to a chart like GE Aerospace, right? There's a clear accumulation phase where we're making higher highs on stronger momentum. There's a potential topping phase when we're making new highs on weaker momentum. That's the infamous bearish momentum divergence that we're seeing here going into the end of October. And then we have a distribution phase where the momentum softens, the trend breaks, the 50-day moving average no longer holds. We're now making a pattern of lower highs and lower lows. I mean, things have changed on the chart of GE, right? It's not the same chart that it was just a couple months ago. So I think that sort of rotation is something we've definitely identified. And we're seeing that also. We're seeing that there are some financials that are pulling back. We're seeing that with industrials that have pulled back. Seeing that in charts like Eli Lilly and Merck and Johnson & Johnson, and names that have been in strong uptrends that are now starting to roll over and, just not be making new highs at this particular moment. So those charts could easily recover. But for now, I'm seeing more pullback phase there. Those are some of the takeaways here, looking at the heat map. And again, quite a few sectors showing some mixed results today. This was very much, while the S&P and the NASDAQ were basically flat, that's what the heat map tells me. There's no one sector that was truly dominant, no one sector that was a clear disaster. They're all kind of just in a transition. And that's kind of what the market usually feels like going into a big macro announcement, right? I mean, the outcome of tomorrow's Fed meeting will most likely be significant. not because there's a lot of question marks on what the Fed announcement itself will be. It's going to be more on the expectations going forward. Do you hear language that implies further rate cuts are coming? Do we hear language implying that that's enough? We really don't need to cut rates anymore. And I think whichever way those comments and those answers lean tomorrow afternoon is going to be pretty valuable, obviously, for identifying what might come next here. All right, let's continue on looking at some charts together. And we'll start with the daily chart of the S&P 500. Yesterday, I believe, we talked about this sort of traffic light approach. We've been talking about this for the last couple shows. For me, I like to keep things simple, as you've probably guessed from watching the show. I think it's very easy to overcomplicate investing. It's certainly easy to overcomplicate any sort of financial analysis, and technical analysis is no different. So I feel like part of my goal in life as a technical analyst is to reinforce to people that they don't have to overcomplicate. Simple and consistent is far better than complicated and inconsistent. That's just 100%. There's no way there's 100% believe that deeply to my soul. So having said that, coming up with a clear framework, right? Just an idea of what you might see next and how that would impact your portfolio, or what changes you might need to make, I think is super valuable in this particular moment. Because what you don't want to do is make an emotional decision. The market rallies, the market drops, and you emotionally react to that, and then you start trading based on your emotions. We want to trade based on the evidence, which means we have to lay out kind of a structure, kind of a game plan about what we would see and how that might inform changes in positioning. So by my read, anything between 6,550 and 6,900 is a yellow light. That's wait and see. Let's see which way this breaks kind of mentality. S&P above 6,900 would be a bullish breakout. That would mean new all-time highs. That means the traditional seasonal strength of December is playing out. And you probably want to be playing on the long side through a Santa Claus rally, reassess in the new year, where there's often a bit of a downside rotation. S&P below 6,550 would be pretty negative. That would be a new 3-month low. That would be, I would argue, probably some sort of head and shoulders like top that's now confirmed. That would imply much weaker price action going into the new year. So I think that traffic light for me is a really good way of just acknowledging where we're at. Acknowledging the fact that the uptrend that was in place through the end of September into October has now stalled out, and we're waiting to see which way this resolves. And I don't think it's particularly clear. I have a lot of peers in the industry, and I read a lot of other people's stuff just to stay informed and see what's out there. And I see and read a lot of people that are super bullish and say this is the most obvious bullish play in history. I obviously do not agree 100% with that assessment. There's plenty of things that are more question marks than exclamation points right about now, but that's fine. We're all allowed to have different perspectives and different things and different conclusions. I don't think this market is remarkably bearish either. And I've seen other people that say this is the most clear topping pattern you've ever seen in history. I think it's very murky right now. And I would say from a trend following perspective, this is a sideways trend. It's not a clear uptrend anymore, and it's definitely not a breakdown. It's a sideways trend. It's a consolidation phase, right? We're waiting and seeing. Maybe this week's Fed meeting is that final catalyst to kind of get us out of this range in one way or the other. We'll see. But for now, I would say it's neutral by my read. Now, breadth conditions have started to roll over a bit this week. And again, I'm hearing a lot of comments about how great breadth is. I don't see that necessarily. I don't see the breadth as particularly strong right now. Particularly the fact that less than 50% of stocks are above their 50-day moving average. Back here, when it's like 70, 80% of stocks above their 50-day, I don't know how you could be looking at that in June of 2025 and not say that's pretty strong breadth. That means pretty much everything's breaking out. That's valid. Now, where more stocks are below their 50-day than above is not strong breadth. That's more weaker breadth. That's more the market moving, trying to break out on much weaker breadth conditions. So I don't see that as a positive. Now, the long-term breadth is still fine, and that's been fine for quite some time, really since May. So no question mark there, but the short-term breadth is what's turning over. The McClellan Oscillator, which is probably the most classic kind of short-term, not day trading short-term, but more just tactical movements, what's happening. McClellan Oscillator almost went below zero today, and that's sort of a clear downtrend phase. Actually, this is through Tuesday's close, I'm realizing. So today most likely did go below there. I don't have the data to see it, but we'll see. But the McClellan Oscillator very, very close to breaking below zero, and I think if that would happen, that tells you that again, in the short term, we're in a weaker breadth condition. That usually means some sort of pullback, or at least a stalled out market is the reality. All right, I shared some charts on social media earlier today. I just wanted to revisit them here. In terms of breadth, right? Is the breadth stronger or not? Is this a narrow lead rally or not? I generally would describe this as a narrow lead rally, and here's why. Because any measure that looks at a broad universe versus a very focused mega cap growth universe, the broad version is struggling. It's lagging, right? So for example, here is the equal weighted S&P 500, which is the RSP. That's an ETF that tracks an equal weighted S&P 500 ETF. That made its most recent all-time high in early October, basically retested that in late October, in early November, and now in early December, but we have not made it above the October peak yet. Here's the S&P 500, which did make a new high at the end of October, once again, kind of testing that level. So these are both kind of holding up there, okay? But down here at the bottom is the relative performance of the equal-weighted S&P versus the regular market cap-weighted S&P. And this has been trending lower pretty much since the April market low. The equal-weighted S&P has been lagging. So what that means is off that April low, the market cap-weighted version has been outperforming the equal-weighted version. What does that mean? That means that the mega caps are outperforming everything else. And that's within the S&P 500, right? So it's not looking at small cap stocks or micro cap stocks. There's some different info there. The micro cap index has actually been remarkably strong, probably surprisingly strong in 2025. But in terms of the S&P 500, it is paid to be as large as possible. The biggest names, the largest mega cap growth stocks have just done better, and that has been fairly consistent. I would also say there are very few sectors that have actually outperformed the S&P year to date. I don't show a lot of tabular data here on Chart This because it's not called Table This with Dave Keller. It's called Chart This with Dave Keller. So we look at a lot of charts, but here's the column, which is the year-to-date performance. And I updated this at the end of the close today. The S&P year-to-date is up 17.6%. Only 2 of the 11 S&P sectors have outperformed the S&P 500 so far in 2025. Technology, which is up about 28%. Communication services up 21.3%. There's the S&P up 17.5%. So only 2 sectors, the 2 growthiest of the growthy, technology and communication services, have managed to outperform the S&P. Everything else has lagged. Now, everything else is up from a little bit to a decent amount, but none of them have outperformed the S&P 500. So we talk about narrow leadership. What I mean is the opportunities to outperform have been very concentrated into a small number of sectors and a relatively small number of huge growth stocks. Most everything else has generally underperformed. You can see that a couple different ways. Obviously, the fact that just everything else has gone up a lot less. There's an ETF ticker SPXT. That's the S&P 500 without technology. So you take out the technology sector and you own the rest of the S&P, you're up 13.1% in 2025 versus the S&P up 17.6%. So you take technology out of the S&P and you're up about 4%, 4.5% less. So any way you slice the sector performance, anything outside of tech has probably hurt your performance, right? In terms of a general allocation. This is the relative performance of the SPX without technology versus the complete SPX that includes technology. We can see that consistent underperformance going, from the April market low to where we're at now. So again, I still see this as fairly narrow leadership, and I don't see any evidence that would argue differently from that. I mean, plenty of things are going up. It's just the things that are helping you outperform fairly concentrated into some growth sectors. Now, in terms of what's actually working right about now, gold and silver, I mean, again, year to date have been some of the better trades you can make. Just owning gold or owning silver has been a pretty awesome bet. The GLD very, very close to, if not already breaking out here this week. Think of the rally in gold. I mean, May, June, July, August was sideways, and this is the GLD we're looking at. Big breakout end of August, September, mid-October, really, really strong. Pullback right to Fibonacci support. That's right around 360 on the GLD there. And then we bounce. And from here, we're making a coil pattern of lower highs and higher lows. We break out of that pattern. We've kind of stalled out. So the gold trade is really not just resounding upswing at this particular moment. It's just generally holding its ground after that breakout. Now compare that chart right there, take a snapshot in your brain, and look at this one. You can see why silver looks kind of like gold if things went really well over the next couple of weeks, right? Here's that same coil pattern from mid-October through late November, higher lows, lower highs. Look how the SLV, the silver ETF, broke out and then just continued to accelerate. So here's gold breaking out and then just kind of sideways. Here's silver breaking out and then just aggressively moving higher. Silver is overbought right now while gold is not. So silver over gold has been the play. The relative performance of either of these versus the S&P has been very strong, which is one of the reasons why I still own gold in my own portfolio with the GLD and the IAU. I believe are the only gold-related things I currently own. But having said that, there are some stocks in these spaces that look quite good. Boy, Newmont, I thought I grabbed Newmont. How did I not grab that chart? Come on, David. All right. Well, I'll tell you what. I'll show you Newmont mining over here. Here's the chart of Newmont. There's only one S&P member that's in the S&P member that's in the gold or silver space. It's Newmont Mining, ticker NEM. The coil pattern looks even more clear on the chart of NEM, right? Look at this rally. Look at the consolidation, lower highs, higher lows, just breaking out to the upside. And today, it's kind of a nice follow-through day, up almost 6% today. Other gold stocks having similar patterns. This is PAAS, Pan American Silver. Similar kind of consolidation, but look at the breakout, the stall, and then the rally today, up over 10% today. So all of these areas, right, gold and silver stocks, all generally outperforming, but particularly I think this week we're starting to see an upside resurgence in silver over gold, but definitely in the stocks, which have been on a bit of a catch-up trade, continue to look pretty strong here. Meta, pulling back 1.5% today. We highlighted this recently because we got down to the 61.8% retracement of the April to August rally. On the way down, we gapped below the 38.2% level, also the 200-day moving average. After bouncing off of support here around 580 to 600, we rallied back up to test the 200-day and the 50-day and the 38.2% Fibonacci level, all from below. That's where we stalled out last Thursday, Friday, and then yesterday, Monday. Today, pulling back from that level. So chart like Meta, for me, is a good chart if and only if it can break above that resistance. I think Meta over 680 is a great recovery story, showing it can get back above clear resistance and buyers are taking control. Right now, I'm not seeing enough buying momentum. I'm seeing the stock struggling to get above resistance. I highlighted on the heat map here, there are plenty of technology stocks actually looking quite good. Here's AppLovin, ticker APP, kind of a classic bull flag pattern. That's when you have a rally over an extended period of time. You then have this counter trend pullback of lower highs and lower lows, kind of a parallel channel. So I drew this line off of the highs. I created a parallel line, matches pretty well with a lot of the lows here in October and November. With that kind of pattern, the pattern is confirmed with a bullish outcome if it is able to power above the upper boundary on stronger momentum. That happened in early December. The RSI pushing higher. We're now testing a new all-time high, but I think the setup is pretty constructive. That's the type of chart I would think of as innocent until proven guilty. Two more charts to share with you. JP Morgan down quite a bit today, almost 5% today. They're had some news about much higher expenses. They cited a number of things in that explanation, but inflation was one of the items, if you read through their the comments. Having said that, this potentially puts a right shoulder on a head and shoulders top. You have a peak here, a higher peak in November, a lower peak now in early December. If that is a head and shoulders top, you have to wait for the neckline, right? So with a head and shoulders pattern, you have the setup, which is where it starts to look like a head and shoulders top. You see a peak surrounded by lower peaks on the left and the right. The second thing is the trigger. Every pattern like this has a trigger. It has a level or a moment where it confirms that that pattern is a valid pattern. And the neckline on a head and shoulders pattern, which is made by connecting the swing lows between the head and the two shoulders. So this low here in mid-October, this low here in late November, a break below that neckline would be the trigger sort of validating that peak. And then I always have a third step, which is called the follow through. Do you have an additional downside move that shows it wasn't just a whipsaw, but really something more significant? Right now we're in phase one. It looks kind of like a head and shoulders top. I'm looking for a break of that neckline and some follow through to validate a topping pattern. That can imply much further downside. The 200-day and Fibonacci support currently right around 275 to 280. That might be a decent initial downside target. Hey, let's finish the show on a positive note, finding a good stock making new 52-week highs. Fox Corp, we've highlighted this chart before. I love the setup. I love the breakout. I love the fact that the moving averages are in the proper order. The price is above the 21-day EMA, which is above the 50-day, which is above the 200-day. The momentum is strong with the RSI pretty consistently above 60 since April. The relative performance is improving as the stock has been outperforming its peers over the last 6 weeks. Strong charts getting stronger, innocent until proven guilty. Those are the types of charts I love to focus on and make sure that I recognize. I would argue the goal in technical analysis, certainly the goal in trend following, isn't to try and predict the future. It's just to recognize trends, right? And to acknowledge them and to have a consistent process of identifying. I hope with our time here on Chart This and with the other work I put on my YouTube channel and elsewhere, you're able to upgrade your own process, identify some decent opportunities, and inject some consistency into your decision-making. For now, I will say thank you so much for watching. Pleasure to have you join me here. I hope this helped you make sense of the markets today and get some ideas about what you could do tomorrow. I'm Dave Keller with Market Misbehavior. It's always a good time to own good charts. Have a good night, folks.